Hello, it's Chris Martin. I'm the Director of Beyond Profit. This presentation is about auto-enrolment. This is the government's latest idea to get individuals to save for their own retirement. The difference in this case from previous efforts is that us, employers, are going to pretty much be forced to contribute to it. So it's going to be an expensive business. Yes, it's quite boring because it's to do with pensions, but it's very, very relevant to anyone with one employee or more. We don't die as early as we used to. Not like the good old days when you could retire at 65 and be dead at 67. Therefore, we're all living longer, but there's insufficient money in the pot to pay state pensions out. So it's a problem. In 1910, there were 10 workers for every pensioner. Today, there's 3 workers for every pensioner, and this is going to get worse. The trend will continue, and it's predicted in 2050 there'll be 2 workers for every pensioner, and then logically, I guess, at some point in the future, it will be a parity. So who's going to pay for the living expenses of these very long-lived people? Well, it isn't going to be the government because there's going to be insufficient money in the system. So it's going to have to be us, isn't it? We're going to have to pay for ourselves, and it's harsh reality. There's no doubt about it. Something has to change. So whilst none of us want to pay for our own retirement, we're going to have to do something about it. The government recognises that an awful lot of people do absolutely nothing about this. So I guess the easiest way to force people is to do it through the payroll, and unfortunately it means forcing employers to pay into it as well. Fair? Probably not, but there we go, we're stuck with it. So what happened in the past? Well, until 2001 there was no obligation on employers to provide occupational pensions for their employees. Obviously people did, and the public sector certainly did, but there was no legal obligation on people to do it. In October 2001, the stakeholder pension regime came in. You might remember this. Stakeholders, one of Tony Blair's favourite words. This was essentially a forerunner of auto-enrolment, really. I mean, the point here was if you had 5 or more employees, you had to set up a stakeholder pension. You had to set up an occupational pension for them. But the issue was they didn't have to join it, and you didn't have to contribute anything if they did. So, funnily enough, people didn't join it, and employers didn't contribute. So it's been a complete failure. Government recognised that, and auto-enrolment is their response. So in the future, what's going to happen is, from a particular date in the future, we'll call it the staging date, we'll look at that in a moment, you must make a pension scheme available to all your employees, notwithstanding how many you have, who earn above the income tax threshold, which at the moment is £8,105, and who are aged between 22 and the state pension age. Okay, and obviously that £8,000 figure will change in years to come, but at the moment this is what it is. Employees earning over £5,564 up to £8,105 aren't automatically enrolled, but they can ask, and if they're asked, you're obliged to let them join. Employees can opt out, but they have to actively do so. That's essentially it. The big deal here is all your employees are automatically enrolled. Auto-enrolment. You can't pick and choose. They're all in it. Okay? Because they're all in it, you're going to have to contribute for all of them, as we'll see in a moment. They can opt out, but I'm not sure whether many people will. As you'll see at the end of this presentation, it's going to be an offence, effectively, to encourage people to opt out or to provide an offer of employment with, exclusions about entering the auto-enrolment pension scheme. Basically, they're all going to be in it, and you're going to have to pay for them. These are staging dates. The staging date is the date you are legally obliged to start running your auto-enrolment pension scheme from, and it's different for each employer, and it's dependent on the size of your payroll. So for the very largest employers, they're already in it, actually, from October 2012. They're already running it, but they would have had a scheme set up anyway, I would have thought, so it doesn't really affect them. For most of us, and certainly for most employers in the UK, and certainly for the sort of clients we deal with, most employers will be obliged to set up their scheme from between 2015 and 2017. So yes, it is a little way in the future for most of us, but it's as well to get used to it now, because it's going to cost you something. Okay. Revenue and Customs will write you about a year before, telling you what your staging date is, and they will write you again to sort of remind you so you don't forget. But feel free to give me a call, give us a call or a shout, and I'll be able to tell you what your staging date is given your PAY reference, because it does depend on that. So what's the bottom line? What's it actually going to cost you? I think that's the thing we're all worried about. The sort of mechanics of setting the thing up isn't that complicated, but it's the cost that's the issue for most people. It goes up. Right? It goes up over time. From your staging date to the 30th of September 2017, the total amount of percentage of employee earnings that's got to go into the fund, the pension fund, is 2%, of which you will be contributing 1%. Bear in mind that earnings isn't total earnings. There are different definitions, but for the purposes of this presentation, earnings doesn't mean absolutely every penny they earn. There is an upper limit of 42,475 and a lower limit of 5564. That means that at the time of recording this, which is in the tax year 2012-13, you will only pay pension contributions on maximum earnings of £36,911 per employee. Still won't be cheap, but at least there is a limit. 1st of October 2017, your rate doubles. Okay, you've got 100% more into your employee pension pot. And again, another 1% is added on from 2018 onwards. So, of course, depending on the size of your payroll, it's going to be a greater or lesser impact on you. But it is an extra cost, which I think we'd all agree in the current climate we could all do without. But we're going to have to do it. We're going to have to pay it. We're going to have to lump it. Nothing we can do about it. Bear in mind, these are minimum contributions. You can pay more. It's not an issue. You can pay more, but of course there will be rules about whacking it up so high that you encourage employees to opt out. So if you said, well, I'm going to, here we contribute 15% and you've got to contribute 15%, people aren't going to take the job, which is going to be quite handy, I guess, or they're going to opt out, rather. So you will be barred from doing that, but you can increase it if you want to. Things to watch out for. I've said here pension scheme can be bespoke or bought from the government. When I say bespoke, I actually mean off the shelf, and a completely different thing, really. But what I meant was you can buy a one from a third party provider, like a pension fund or an insurance company. There are shed loads of providers doing these things. Or the government has set up its own scheme, which is intended to be a low cost scheme. So that might be worth looking at, called NEST, or the National Employment Savings Trust. Maybe worth looking at that. Depends what they're going to invest in, but at least it could be safe. So it might be worth looking at that. Non-compliance will result in penalties of up to £10,000 charged by the pensions regulator. Now, I think you'd have to be pretty naughty to get charged £10,000. But bear in mind, I think they're going to take this very seriously, and I think we're going to see some pretty hefty fines levied, particularly for behaviour such as encouraging overtly or discreetly employees to opt out of the auto-enrolment pension scheme, for making offers of employment that suggest opting out would be a good idea. These sort of things are going to attract penalties, so I would think carefully before engaging in that sort of behaviour. So it says here, non-compliance includes encouraging employees to opt out. So be careful. Fundamentally, although it's a big change and it's an expensive change, it is actually quite simple, this. All you've got to do is go to your insurance company or the government through the NEST scheme, buy into an auto-enrolment pension scheme and get everyone enrolled on it. The compliance aspects are fairly simple. It's simply operating pensions through the payroll. That's easy enough. It's understanding your software, basically. The big issues for you will be getting it started by the staging date, operating it or making sure people are enrolled and you don't do anything silly to encourage people to leave, and of course making the correct contributions into the scheme. So the major issue is cost. It's going to cost you money to set the thing up and to run it. I'm afraid there's nothing we can do about it. It's like employers, national insurance. It's just an extra tax on us, really. But that's the way it's going to be. You've got plenty of time to budget and to think about it. So start thinking about it now. If you have any questions or need more detailed information, as always, don't hesitate to give me a call. Okay, cheers. Bye.